want to talk markets, the Fed, and so much more. Greg Fleming is here, President and CEO of Rockefeller Capital Management, also former President of Morgan Stanley Wealth Management. It's nice to see you, sir.
Great to see you, Andrew.
I think we're all trying to figure out what's happening in this crazy market. There's, as we get to October's always that scary month. September, you and I, well, we've all lived through September also back in the day.
That anniversary is coming up again.
That anniversary is coming up as well, back in 2008. So where are we really, in your mind?
One thing I'll say is that people get agitated quickly when markets start to move. But a few fun facts for you. If you go back to 2011, there were 35 days where the market moved up or down more than 2%. Mm-hmm. And in 2012, there were 21. In 2023, there was 1. And so far, there's 3 this year. So we're at a pivot point in the economy where the Fed is obviously moving in a different direction, where things are clearly softening. You look at the numbers yesterday, the beige book and employment. So whenever you get to a pivot point in the economy, you're going to see more volatility. And it's just normal. It's the market kind of flushing and working its way through in terms of what's going to happen now. So I think a lot of this is just normal market reaction to a changing macro backdrop. And the volatility has been extremely low in the last couple of years.
Well, so what are you telling your clients, though? You have a lot of high net worth clients in the world who are all trying to figure out what they're supposed to do with their money. Some of whom have cash on the sidelines and they're sitting around. And some of them are asking, hopefully they're not asking, are we sitting in September of 2008? But we're also at an election year, by the way, also happened during 2008, adds to the volatility. How bad is it out there? Is this a moment to be stepping back in? Is it a moment to wait because you think that things are going to be crazy?
Well, one more factor. If you go back to 11, 12, where there was a lot of volatility and a lot of macro uncertainty, the S&P's up almost 500% since then. So what we tell our clients, and we have the best advisors, private advisors in the industry, they have a long-term plan in place with clients, and they say stay steady with the plan. Clients and advisors right now are looking at the election. There's more uncertainty. But they're sticking with...
what do you tell them on the election front, by the way?
It will matter who the next president is. I mean, the debate around tax plans, you're starting to see a little bit more specifics come out here. One thing that's amazing to me when we get into the election is everybody's staying away from the most important issue from an economic standpoint, which is deficit spending. You don't hear either candidate talking about deficit spending. The American people, the American economy, we are spending $3 billion a day in interest expense now. Weekdays, weekends, $3 billion a day in interest expense on the debt. And last time I was on here, I talked about how interest expense on the debt was going to exceed the defense budget. Well, now it does. And you don't hear anybody talking about the fact that at some point, and it's not so far away now, we have got to, as a nation, this isn't a political statement. It's a statement about the country. We've got to deal with this issue.
It's a statement about math.
Math. It's just math, Becky. You can just avoid the whole political debate, which party. It's just math. You can't continue to spend 6 to 7% deficits as a percentage of GDP indefinitely. No country has successfully done that ever. Sorry.
No. Go ahead.
Well, I was just going to say, you're an expert at the markets. Markets are the ones that sit up and say, no mas. This is not going to happen anymore. It's when is there a pushback on Treasury buying to say we're not going to continue to do this because the politicians aren't going to address it until their hand is forced?
Becky, it's a great question. And I still think that at some point here, you could have a higher rates farther out on the curve simply from a supply and demand standpoint. Because they
Meaning the Fed can't lower rates and have it stick, the market would say.
The market says no. They start pushing back on the Fed. The amount of debt that is refinanced on a regular basis now, the numbers are staggering. So at some point, the market will rein that in.
By the way, I don't disagree with you. I agree with you entirely. The question then gets to the hard part, which is which services is the U.S. government not going to provide to which Americans, right? And so what happens, by the way, I think is a lot of people see us talk about how we got to cut. Because that's the only way the math is going to work. And they say, well, we can afford to live with whatever the cuts are because we are not going to be the ones that are hit by whatever those services cuts are because we've been lucky enough to be in a place where hopefully we can afford some of these things that maybe other people can't. So the question therefore then gets into sort of the nitty-gritty of it.
Well, let's go back to math, though, where Becky was. Just the math of it. The deficit today is a result, when you look at long-term trends, 50 years, as a percentage of the economy, it's spending that's out of whack.
100%.
Revenues are where they've been for the last 50 years. So there has to be some agreement on what can't we as a country afford, because the blip over this recent time frame that's created such a significant increase in the deficit is on the spending side. So there has to be and this is where, there is a center to the country. What, some people say 85% of people are really in the center. The center needs the political parties, and maybe the markets will force it at some point. And when that happens, though, Becky, because I ask all of my friends who are around this topic the same question. Okay, so what's going to cause it to pop? People have talked about we lose the reserve currency, maybe rates spike beyond the Fed's control. When is that going to happen, and what will it be? But if we get to that point, that's going to be a big problem, because it'll be something that nobody foresaw.
It's not going to be a clean or easy fix.
It's not going to be a clean or easy fix then. It'll be forced.